All
There we
right.
go.
Hi, welcome, Kon. How are you?
I'm very well. Thank you very much. Thank you for the invitation.
You're welcome, Kon. And it is absolutely a pleasure to host you today to this podcast, which is really how to structure around your properties and when you're looking as an investment. So thank you for taking time out and being here for us for another 45 minutes to an hour. Now, this session obviously is for people who are listening to this. They are either very naive in understanding about property. Even if they do understand property, a lot of people get stumbled upon, obviously taxation when it comes to capital gains and so forth. So we're going to try simplify this in today's session to try see what we can extract out of you from a taxation perspective. But before we get there, would love to hear your background and what you do and exactly what business you're in, and of course your company's name as well. Thank you.
Certainly. Thank you very much. My name is, as it says on there, Kon Floudas. Delphi Accounting and Delphi Finance are two of the companies that we have. Delphi Accounting primarily works in the small to medium business space. We have some high net worth individuals, but it's mainly medium businesses that we deal with. We assist them with all facets of taxation, but one of our specialties, and I guess one of our passions, is property investment. So I've been doing this, as I was saying to you a little earlier, near on 30 years. So I've seen all the property cycles and, not so much the ups and downs, but the concerns people have over a period of time. And one of the things that I've learnt very early on, and one of my mentors actually said, there's no magic bullet. There's no tricks in the tax code. There's nothing that's hidden. It's all about setting up the structure, whether you're calling it, whether it's a business structure or a property structure, setting it up right from the start. And what essentially that means, and as I said, I've been doing it for 30 years, initially started with Deloitte's in audit, then business services, helping business owners with how to structure their business. We set up our business 20 years ago next month. So we're almost 20 years in the game as our own practice.
Wow.
And we're very keen to ensure that people have conversations, not only with their accountants, but also with, buyers agents, with brokers, with their lawyers, because the successful people surround themselves with people that have got expertise in certain areas to ensure they get the right advice. Because you've got to set up the structure correctly from the start. And I always say to people, set up with the end in mind.
Yeah.
Where would you like to be? We don't have a crystal ball, but everyone's got an idea of where they'd like to finish. And I think that's the best starting point. We work backwards from there. Have a look at your specific circumstances. What's your family unit made up of? Who are you looking? Are you looking to create a legacy? Are you looking to hand down wealth to children, to grandchildren? Are there extended family members that you'd like to support or like to get involved in this? It's a matter of understanding each individual's unique circumstances and working backwards from there to create something that works for them. And if anyone wants to go to my website, the first thing they'll read on there is, I didn't want to be an accountant. And I changed my mind when I realised what we do is actually problem solve for people.
Yeah.
So it's not about the debits and credits. It's about helping people solve a particular problem they have at a particular point in time.
Yeah.
And to be honest, if you would ask me, what's the passion, what gets you up in the morning? It's actually solving problems for people and seeing them succeed, whether it be in business, in property investment, in simply solving a simple tax issue they may have with the tax office. That's what drives us. That's what we have the passion for.
Absolutely. And I guess
Not sure if we're still on.
yeah.
I think
Yes, we can hear you.
Anabar, I think I've lost you for the moment. I'll wait till that comes back on.
Can you hear me?
Otherwise, I'll put people to sleep by continuing to talk.
Now you can keep going because I can hear you. I can. Can you hear me? Okay.
Maybe I should continue to talk. Okay.
Yes.
I'm assuming we're on, so I'll continue for a little bit longer. When it comes to property, and we're talking about property primarily, Australia has one of the most complex tax systems. We've got to look at, here we go. I'm not sure if I was still on, but I was just saying that Australia has a
Yes, you
very
were on.
complex tax system
You
when it
were
comes
on.
to. So there's a number of things we've got to look at when we talk about property. We've got to look at tax efficiency. Are we minimising our capital gains and the income tax are we paying? Asset protection, are we protecting our investments from creditors, lawsuits, personal liability? And also wealth transfer. How do we set up our assets in a structure that allows us to potentially pass on assets with the least amount of capital gains tax or tax of any sort? And whilst we're building our wealth in property, there's not only the federal taxes, but there's also the various state taxes. So as I said, it's a very complex area when it comes to property and taxation. And every so often, governments will make an announcement, state governments will make an announcement. Things like land tax changes, they give incentives, they take incentives away. Every state is different. It's never static. So it's always good to, as I said at the start, surround yourself with experts and get expert advice, because whilst people may think, well, hang on a minute, I'm paying money for all these experts to assist me on it, why should I pay this money? Let me tell you, the successful investors pay to get the right advice. None of us have the time to be a jack of all trades. We can't source property and source the right property in the right location at the right price. We can't become tax experts and we can't become finance experts. So that's why we always recommend get a good group of experts around you if you're serious about growing wealth in property.
Absolutely. Can you hear me okay, Kon, at the moment?
I think we might have lost Anabar again.
Oh, that's
I'll wait
interesting.
for a tad.
Kon, can you hear me now? Is that better?
And if I should mention, I'll keep going. If we should mention some of the things we look at when we talk to our clients in relation to property, we talk to people about the legal and the financial framework when they look to set up a structure to buy property. I'm not sure if I should be answering questions here or listening out for questions, but I'll continue.
Kon, I
So,
can
for
hear you.
example, when we talk about the legal framework, it's all about what sort of structure is best for you. When we talk about financial framework, it's tax efficiency. Do we use leveraging? Do we use depreciation schedule? What sort of structures do we put in place in respect to our various income streams? Can we split income? Do we put it in a trust? Another thing we look at if you're planning to build a long-term property portfolio is to look at diversification as one of the pillars of your investment strategy. And when I say diversification, we're talking about both geographical spread. Don't put all your eggs in one basket, be it Brisbane, Sydney or Melbourne, and don't necessarily mix one asset type. You might want to look at commercial, which has got higher yield, whereas residential generally has better capital growth. One of the other things we look at right from the get-go is risk mitigation. And that could mean ensuring that you're managing your debt properly and you don't over leverage. Because at the end of the day, the bank may lend you X dollars, but can you sleep soundly at night and can you manage to make these payments? We recommend people always have a certain amount of cash reserves, for example, for what they call the rainy day, things that we're not aware of. Importantly, if you're going to invest in property, and buyer's agents will tell you this, don't get emotional with property. Property is an asset, it's there to grow your wealth. And don't underestimate costs. Quite often land tax, strata fees, there's all sorts of hidden costs. You've got to be aware of all of them. You don't want to be hit with surprises. Not too sure if you want me to keep talking. I'm not sure if I've put your audience to sleep.
No, I think I can hear you, but you probably can't hear us for some
I can hear
reason.
you. Yeah,
You can hear me now.
That's
Okay.
fine.
All right.
Yes,
All
yes.
right. So because I think I lost you in between before that, but thank you so much for answering that.
I kept
I
talking.
really
I'm not sure if anyone heard any of that.
no. Everyone's heard it, so we could hear it very
Okay.
well.
Well, good. We can keep going.
Keep going. Yes, so I've got a few questions for you, Con. So I think it's brilliant. A lot of first home buyers who come forward and talk to us about it, one of the questions that they ask is, should they be buying their first home in a trust, or should they buy in their names?
Again, and what I'll say right from the get-go, there's no such thing as a magic bullet or a single correct answer for any question. So it
Right.
always depends on their specific circumstances and also what they want their end goal to be. So are they renting? And a popular term now is rent vest. So are they
Yeah.
planning to rent for a while in an area that they like, and they want to buy an investment property in an area they can afford? Now, if that property is going to be their owner occupier, well, as we know, there's no capital gains tax on a property you buy in your own name.
Yeah.
Now, you can put an owner occupier in a trust structure. It's a little bit more complex, but there are ways of doing that. And we've got clients, for example, in the medical profession, that want to protect it, even though it's their first home. They're an owner occupier, but because there might be risks associated with their profession, we can still put that in a trust, protect that asset, and they still get all the capital gains tax exemptions. A little bit more complex, but it can be done. And again, it depends on people's circumstances. If you're a first-time property investor, you need to decide, is this going to be my first home, for example? I'm going to have it for 5 years and then I'm going to move on, or do I want this as an investment? And
Yep.
it really is a question around what are you looking to do? There's no right or wrong answer. It depends on what your clients are interested in doing. Keeping in mind, of course, that if you buy it in your own name and it appreciates, there's no capital gains tax. And
Yep.
if you've made the effort to pay down that quickly, you can use the equity, obviously, to buy into an investment property soon thereafter. However, there's nothing wrong with buying the first property as an investment property, gearing that property, potentially getting some tax deductions, and staying put in the house that you like to live in. I must admit, though, I'm not a fan of negative gearing per se. I'd prefer that you got a property that was positively geared as quickly as possible, gear into the next property, increase your wealth quickly.
I love that because I know a lot of people are being advised otherwise that yes, negative gearing is a benefit which most people want, and especially high income earners are looking to buy anything under the sun that gives them a huge negative gearing as opposed to positive. So, what should people, let's say there's a family income of close to around, say, $400,000, for example, and people are looking to invest in properties and they go through a structure to do so. Of course, as we understand, there's no direct negative gearing in trust. So most people end up choosing that to be in their names because they can get maximum tax deduction. Is that the right way to look at it? Because you just said positive gearing is better. How should they be saving tax in that scenario?
If they're self-employed, depending on what structure they're running their business in, let's say, for example, they've got a business in a family trust. You can set up a property trust, and any losses in that property trust can be soaked up by profits in your trading business.
Okay.
So, as one very simple example, if you're in a PAYG and there's negative gearing availability, you've got to assess, and it may well be worth, if you're on a high income, it may well be worth getting the negative gearing benefits and getting that tax rate back if you're on 47%, for example. If you're looking to hold that, let's say for 5 years, that property appreciates. You take all the cash advantages of negative gearing up front, and then if you sell it, you may have to pay some capital gains tax, but you can make that assessment if it goes up by, let's say, 7% a year, for example. What are my tax benefits going to be from a negative gearing perspective versus the potential capital gains tax when I sell?
Yeah.
Now, you could do that exercise from the get-go before you actually purchase the property to give you an indication of potentially what each scenario will give you.
Sure. So let's take a
You may, for
scenario.
example, have one of the partners on a $400,000 income and another one on a slightly lesser income. And if they're both on a wage, you have a look at what structure works best and who holds the majority of that property. There are ways of, it doesn't have to be a 50-50 split, for example. There are various structures. What I suggest is whoever's looking to buy their first property and you've got a great income, another way of doing it, let's say you've got 400,000 available to you, is to consider, and it might be early in someone's life cycle, but you could always consider buying that property in a self-managed super fund, contributing some of your super guarantee from your employer, and you can even salary sacrifice into your self-managed super fund, which pays tax at 15%.
Mm-hmm.
And that's another way of actually getting a benefit, because you're salary sacrificing into super. That super is going to pay off that property in your super fund. So the dollars you're salary sacrificing, you're essentially parking into the super fund as income at 15% and not the 47%. So even on a high income, there are ways of negating that, and it doesn't necessarily have to be negative gearing. Meanwhile, the property in the self-managed super fund is getting the full effects of depreciation, for example, whilst paying tax at 15%.
Yeah, and of course, super is one of the great ways to do that. However, outside superannuation, and if someone is on PayYG, help me explain this a little bit better, because we always struggle with this question when it comes forward. So let's say someone is really, as a family, earning $400,000, and they go through the trust structure to set them up and buy the investment property in the trust. And let's say that property is for 500,000, for argument's sake, and say they hold the property for 10 years, and that doubles in value, and that becomes $1 million, for example. So you've got a 500K gain, right? Now, this property that's been held for 10 years, let's say they've had a negative geared position inside, which means the losses are carried forward, and that's a $10,000 every single year, as an example. So, which means that in 10 years' time, they've got $100,000 as loss booked in the trust because they can't get the benefit of negative gearing in trust. What
Sorry, folks, we've
happens?
lost the connection again, unfortunately.
Oh, can you hear me now, Kon? Oh, no.
I'll wait till we get the full question.
Oh, okay. How about, can you hear me now? Con, can you hear me okay?
I guess, look, I'll proceed on the assumption that we've got a trading loss sitting in the trust. Now, if we're going to sell in 10 years and that property is still negatively geared, or 5 years and it's still negatively geared, that loss is captured and kept in that trust, but you don't lose it. So at some point down the track, if you buy another property in there and it's positively geared, before you pay any tax, it has to soak up the loss on the first property. If we've made a $500,000 profit in 5 years on that property, then we can distribute that capital gain to whomever is a beneficiary of that trust. So generally, if mum and dad set up a trust, the kids are beneficiaries, grandparents can be, or parents can be beneficiaries of the mum and dad, other family members, but also companies and trusts, other trusts can be beneficiaries. We can distribute that capital gain to whomever in that group has the lowest tax bracket. So for example, let's say there's a couple of kids that are 18 years, but they haven't started working yet. Possibly mum's earning half of what dad's earning. The capital gains tax can go there. A portion can even be distributed to grandparents as long as it doesn't impact adversely on their pension, if they're on a pension. And we've also got the benefit of distributing to what we call a bucket company, which can reduce the tax to either 30 or 25%, the capital gains tax.
Oh, that's fantastic.
I'll wait
Can you hear me?
till
Can you hear
we're
me,
back
Con?
on. I suppose in the meantime, Stephanie, do we have any questions? Can't hear anybody.
We can hear you, Con.
Oh, sorry. Okay,
We
I
can
sort of
hear
gave
you.
a brief example if we had capital gains tax trapped in there.
Yes, I got that.
That-
Yes, we got that.
Okay.
Yes, thank you.
I
We can hear you
wasn't
very
sure
smoothly.
whether
It's all
that was the
good.
question you were alluding to.
Yes, that was a question. That was a question. So I think even though what you're saying is you don't really lose the real benefit of deduction on negative gearing, because at some
Not at
point in
all.
time in the future, you can still benefit that through on maybe if the income is 400K right now, and after 10 years that income is 500K, you're actually getting deduction on a higher tax itself, isn't it?
Well, if their income, if it's sitting in a trust, their income isn't really impacted. But at some point, if we sell that property in 5 years' time, we've got to distribute the capital gain. The
Correct.
losses that are sitting there, the negative gearing losses, will stay there.
Yeah.
And it will mean at some point, if you decide to put another, and that's why, going back to my point at the start, that's why it's very important to understand what their goals are from the start. Because a
Sure.
trust may not be the best structure if they're not interested in building a portfolio up in that entity.
Correct. Okay.
It may be that it's simpler to put it in their name, get the capital, get the negative gearing losses up front each year. And then when you sell, you get 25% discount on the capital gain and you pay tax on that. It really has to be understanding what they're seeking to do, have at least a draft of a long-term policy for this particular couple that's on that income. But I guess conversations I would be having with clients on that sort of income with potential to earn the same, if not more, is definitely a conversation around building wealth up, whether it be in a trust structure, SMSF in their own names, or a combination thereof. If you're going to be earning that sort of disposable income, then you definitely have to be looking at putting strategies in place to allow you to build up wealth in property. The whole gain of property investing is not to get the year-on-year deductions or not.
Yep.
It's to put you into a position where you've got a portfolio that's got a mixture of capital gain, but also a good yield, so that at some point you can essentially start replacing the income that you get from work with income that you get from property. And that is a bit of an art, but it's a matter of getting good cash flow properties, and that may be commercial properties. And we're having success with clients buying good cash flow properties in their SMSFs. Or it may be that you basically buy assets simply from a wealth creation point of view, a capital appreciation point of view, where you might accumulate, let's say, 6, and at some point in the future you sell down 3. You've got the 3 remaining, which are debt-free, and simply give you an income of, let's say, 1,500 a week in today's dollars.
Yeah, absolutely. Actually, we end up buying
Sorry, I've
commercial.
lost you again, so I'm not sure if there's any other questions.
Kon, I think it might be the internet, but we can hear you very well. Can you hear me okay? Sorry about the. I think I can.
I think
Sorry,
if we've
audience.
got, I'll
I
just
think
keep
we're live.
talking. If
Yeah.
we've got clients that have got good cash flow, is to look at using the equity in existing property or using the money they've got to leverage into property. Because you've got the multiplier effect. If you borrow, if you've got $300,000 and you buy a property that's worth 600, you've got the multiplier effect. You've got $600,000 working for you to grow, as opposed to 300 invested and getting a 7% return, for example. But it does really come down to having a conversation around, in every respective circumstance, where would you like to be? What are your priorities? What's your wish list, essentially? And then working with people to try to achieve that.
Sure. Can you hear me? Okay,
Yep,
Kon?
I can hear you, yes.
Right. So another question I have is, can you transfer property from my name into a trust? Because I get this a lot as well with my clients.
You can definitely transfer from your name into a trust. There's only one small catch. You've got to
And
pay
what's that?
stamp duty.
Right.
So,
And is
and
that
again,
the
and
yeah?
I'm going to sound like a broken record, and for the young ones, they probably don't know what a record is. That's why it's important to set it up in the right structure initially, because if you've got a property in your name today and it's worth 500,000 and the stamp duty was 40,000, a transfer is effectively a sale from a capital gains tax point of view. So you could potentially have a capital gains tax, and when it goes into a trust, there's stamp duty to pay.
Makes
In
sense.
addition to all the other legal costs, etc., that go along with doing a transfer. The only time you can transfer without the cost of stamp duty, but if it's an investment property, potentially there's capital gains tax, is if you transfer to your spouse, your partner, for what's called love and affection. In that case, there's no stamp duty.
Perfect. And if you can have multiple, there's another question that's come up. Can you have multiple family trusts?
Okay,
Can you
let's
have
see if we can talk about some other things that might be important.
Can I have multiple family trusts? Con, can you hear me?
Probably easier if we had questions, because that way I can have a conversation around what people are interested in hearing about.
The questions are posted actually, so maybe you can't hear us.
But again, depending on your circumstances, asset protection is very important, especially if you're in business. If you're a business owner, and even if you're in a profession earning a high income, you never put property assets in the same trading entity as a business, because if the business goes pear-shaped, they can go straight after those assets. If those assets are in your personal name, and you may have given personal guarantees to a landlord or something like that, they can also go after those personal assets. That's why, again, planning from the start, understanding the risk profile of an investor and what they want to achieve is so important. I think half the time should be spent on what you want to do and why you want to do something and where you want to go, and then you can have a roadmap to get in there.
Right. Can you hear me now, Con? Or are we still not?
I suppose, and this is just a bit of a heads up for property consultants and property buyers and buyers agents. Use buyers agents that have got breadth and spread across Australia, because you will be able to take advantage of properties in different geographical locations. Bear in mind too that depending on the structure and depending on the state you're in, land tax and stamp duty is different in the respective states and also under different structures. So it's always worth having a conversation to understand, because quite often trusts and companies may pay higher land tax, but you may reduce the risk by putting them in these entities. So it's a matter of assessing what your needs are. Apologies, but I've got no questions, so I'm sort of running blind a little bit at the moment.
Con, can you hear me now?
What else can we talk about?
Can you hear me now, Con?
Yes, sorry.
Yeah, I think there's some internet issue at your end, probably what's happening, but the stream, they can hear both of us very well. So
okay.
if you lose me again, let me
I'm
know.
losing you. So here we go. I've lost you again. Don't know why that's happening.
Can you hear me now?
Okay, I've got you back.
Okay.
Can I have multiple family trusts? You can have multiple family trusts. I see one of the questions there. You can have multiple family trusts. The question needs to be, why would you want to? I mean, there's nothing wrong with doing that. But there is a cost structure in setting up a family trust and a trustee company. And so there has to be a legitimate reason as to why you think you may need to. You don't get better asset protection by having more than one family trust. Where it may be beneficial is that one lender may take security over a particular family trust and corporate trustee and take security over that particular asset. And therefore, it's a bit like avoiding cross-collateralization when you go to a bank. The other properties are then available for you to use for other investments. But we need to understand what you're thinking behind having more than one family trust is. I've got a scenario there.
Sorry, can you hear me, Con? Is that better?
Yes.
Yeah, so in that family trust question, my understanding was always that if you have one property in one trust, it maximizes your asset protection. Isn't that true?
Well, you've got the same asset protection. The only difference is that in many instances, you can go to a lender and they take security over that property. and they don't have to go after the other properties, for example. They could be on a clear title or they can be with another lender.
Yeah.
But you sort of got to assess the risk and understand that, because if they take security of Trust A and Trust A has got 5 properties under it, then they're essentially got security. All those properties are security for that asset.
Correct. And that's what I
But
mean
they
by
need to
asset
be
protection.
wary of the costs associated with that. You'd want
Right.
to put you want to put assets that have got the potential for a lot of capital growth in something like that.
Yes, absolutely. So, I mean, there are a lot of people who club the assets together in under one trust to maximize the gain. So, what you're saying is, let's say there are 3 properties in one trust, and there are 3 different banks that I'm with. Are you saying that is still the same asset protection as actually having 3 different trusts?
Well, the asset protection is similar. I guess it's a matter of who are you protecting the assets from.
Right.
So if if you're a PAYG and you're on a decent income and you've got them sitting in a trust, you're not reducing your asset protection by having them in different trusts. What you're doing is essentially, if you've got lender A lending to trust number 1, the other trusts in the other 2 properties, for example, aren't captured by lender A. If something was to happen, they can only go after property number 1. So you're mitigating the risk in relation to the lender. And that's a matter of, why do you think there's a risk to that lender? Is there potential you may not be able to pay? Because generally a lender will say, sell down the property in the trust, pay the debt out. But quite often, bear in mind too that a lender may have personal guarantees.
Yep.
So I may have a property in 3 trusts, but I still may have to sell down property in the second trust or the third trust to fulfill my obligations to the lender in property number 1 if I need to. So you've got to be
Correct.
wary. Sometimes we've seen cases where people assumed I've put it in a company, I've put it in a trust. That's all well and good. I've got to pay back $500,000. They sold it for 300,000. Get the other 200. Well, but it depends on whether or not you've signed personal guarantees. So it's very important to be aware of your legal obligations across the board. And banks are, they've been doing this for a long time. They're not naive. You've got to be a fairly sophisticated investor for them to actually mitigate that risk and say, well, we're going to only take security on the property. More often than not, they will take personal guarantees on the individuals as well.
Right. So,
I did see
so
another
Kon,
question, but it's disappeared.
no, I'll show you the question.
Stephanie, if you want to put the questions up, I'll see if I can read them out and we can cover them off that way. And let's see if I can grab that, sorry.
Can you see the question?
A couple have gone through an investment journey and have bought and made money and now paid off the PPR mortgage, now looking to cash flow. Should they go for a trust structure, multiple trusts, or individual names? Okay. If they're looking for cash flow, just additional income, I would say a trust structure is better than individual names, because if you've paid off your PPOR and you want to buy an investment property for cash flow purposes, or you've got properties already giving you a positive cash flow, that money that you earn in your name will be taxed at whatever marginal tax rate you're on. So if you're on 47 cents on the dollar, the money on top of that will also be taxed at 40 cents. You may be on a lower tax threshold, but the money coming in from the rental income will maybe take you to a higher tax bracket. So it's always best to have money in a structure like a trust, because that excess money will go to the lowest variable tax rate within the group. And that may mean a bucket company, for example, which is capped at 25 or 30%, depending on the circumstances. A trust gives you the flexibility to flow the positive income stream to whoever is going to give you the best result within the family group.
Yeah, thanks. That makes sense, Con, actually. We've got another question. Can you hear me okay?
Yes, I can.
If a couple separates, how does the trust secures their asset for the bloodlines?
Okay, so there are bloodline trusts, and we work with very good lawyers that create bloodline trusts. They assist because you've got an agreement in place which says this asset is going to go to a particular bloodline, but you've also got to look at who has been paying. Even though you've got a bloodline trust in place, that's not 100% guarantee that that asset is safe. So for example, let's say you've got a husband and wife, and the bloodline is in the wife's name, but the husband has also contributed to paying the debt on that trust. He has got an economic benefit in that asset, even though it's in a bloodline trust. It depends on the arguments put to the federal court, for example, because they can look through the veil and understand who's also contributed to that asset. Along with the bloodline trust, there's also what the Americans like to call a prenup. It's in Australia, it's actually a financial arrangement that can be done prior to a couple getting together, whilst they are together, or even after they separate. And we've got some very good lawyers that deal specifically in those areas that have got probably more experience than I have as far as working in that particular sphere with couples that are separating. And they do these financially binding agreements, which assist very much so. And so if you're going to look at property and you're going to go into a relationship, a financially binding agreement is as important as a bloodline trust.
That makes a lot of sense. So actually, what happens is people accumulate a lot of wealth through whatever they do, and then of course, when they die, the trust doesn't die, but the assets are in that trust, which are passed on based on whatever
Oh,
is
on
there.
bloodline.
Yes.
Yes, and that brings another I suppose factor in the equation, and that's estate planning, which is something we also do. So, and
Yeah.
that's why I was saying right at the start, you have a conversation about if you want to build up wealth in a structure like a trust, you then talk about legacy and what you'd like to do with that wealth, and then you have a conversation around estate planning. What should that look like? A lot of families want to protect the assets they've built up to be handed down to their families. So bloodline trusts are an excellent idea. And Abbott and Morley is the firm that we use to give them a free plug, and they specialise in this area. And also a financially binding agreement is one of the best things I can recommend for people going into building assets in that nature.
So
And it's
that
not a
does that.
comfortable conversation, but I think, it's a conversation that needs to be had.
So can that trust be changed
And
later to
again,
bloodline?
my point earlier was surround yourself with experts. We do that as well. I'm not a lawyer by any means, so I would seek out specialists in divorce law for a financially binding legal agreement, for example. I would seek out lawyers that specialise in estate planning to put a bloodline trust in place. There's all these experts that I also use to ensure that I can provide my clients with the right level of service and the correct advice when they want to, build a portfolio in property.
Perfect. Can you still hear me, Con? I just have to keep
Yes, I
checking.
can.
Perfect. So if it's a normal trust, is there a separate arrangement to turn it into a bloodline trust, or does it always have to be from the very beginning?
You can convert a normal discretionary trust or family trust into a bloodline trust. The
Okay.
firm that I mentioned earlier, we use them, and we've done it for our own trusts as well, where, many years ago we weren't aware that this was an option, and they will actually convert that trust into a bloodline trust. And we
Awesome. So
also
we have.
look at when we also look at estate planning, and we have the conversation around a financially binding agreement and discussions on how that should be set up and when it should be set up, and we can guide them on that as well. Again, we get experts in their field to prepare this, but we have the whole suite of experts around us to assist.
Awesome. Thank you. And we have another question from Samir. To pay the profit into bucket company,
Okay, to
does the
pay the
bucket
profits into a bucket company, does the bucket company need to be in the
trust deed?
trust deed as one of the beneficiaries? Good question, excellent question. And normally when you create a trust, The trust will say you've got your general beneficiaries, let's say mum and dad, and then it's any individual, children or parents, or also any legal entities that are associated with the general beneficiaries. So if there's a company that have got mum and or dad or both as a shareholder, that automatically becomes a beneficiary of the trust and you can distribute to it. And when we set up our trusts, we ensure that they're broad enough to allow for entities like companies. We may have a special, quite often we'll do a special vehicle project where we set up a company just to hold a particular property, or it can be just a property that's in the business of developing, sorry, a company that's in the business of developing, and that by default, because of the way the trust has been set up, allows for that company to become a beneficiary.
Right. And Kon, can you still hear me okay? Okay, Kon, can you hear me okay? Right. Okay.
My apologies, I've lost you again. But if someone's in the business of, for example, let's say, I know, for example, some clients like to do small developments. If you're going to do a small property development, or there's a group of people that want to do a small property development, one of the things we recommend is what's called a special purpose vehicle, which is a company specifically set up to do that development. It's a one-off, and it simply is set up for the construction and the sale of that particular property. So special purpose vehicles, or companies that are special purpose vehicles, are done up for people that want to get into small scale development. And in that instance, you're treating it more like a business than a property investing.
Right. Can you hear me, Kon, now?
Yes, I can. Yes.
Perfect. So, Kon, I hear a lot about 6-year rule. So, let's say someone is
Might
in
want
their
to put
home.
the property. We've got a question. Sorry, you've lost you again. The 6-year rule. Okay, the 6-year rule is if you bought a property as your principal place of residence and you've lived in it for, the intention was to live in it as a principal place of residence, but you may have changed jobs further away or interstate or whatever the case may be, and it's no longer suitable for you to live there as a principal place of residence. You can move out, you can rent, or you can buy another property, and that original property becomes an investment property. It allows you to claim all the deductions, depreciation, and negatively gear, but you've got to move back to that principal place of residence within 6 years. Otherwise, you lose the benefit of it being your principal place of residence. But if you do that within 6 years, you've taken advantage of all the negative gearing aspects of property investing without paying the capital gains tax if you then decide to sell. So if in 2025 you've bought a property, in 2026 you find it's not suitable, you've moved out, let's say, to get a job across the state, you can move back before 2032, having taken advantage of 6 years of negative gearing, live in that property for a little while, sell it, and there's no capital gains tax. You can move into that property, and then if you get a job elsewhere, you can move out again for another 6 years. So if you like hopping around, you can do that for a while.
So, how long is that period that you can go back, that you have to go back before you can reset your 6-year rule?
Well, it's generally, 12 months, but it has to be the intention was that you went back to stay there as your principal place of residence. It comes down to the particular facts. It certainly can't be done, within a month or two, because you might be able to legitimately say, well, this is, my intention was to go back, and then I got a great job offer a month after I moved in and, had to take up the job offer. And that's legitimate. Generally we'd like to say, stay in there at least 6 months. But you've got to look at each individual circumstance. The tax office isn't going to argue against you if you can prove that, within a month of moving back, you had a great job offer and you had to go away. Or even you've bought it with the intention of staying there and within a month of buying that property, you got a great job offer. You couldn't give up the money, so you moved away.
Makes
It comes
sense.
down to the individual circumstances at the time. If you can mount a valid commercial argument for why you did it, there's no reason for the tax office to argue. What the tax office is looking at is that you did something purely from a tax minimisation perspective. But if your reasons for moving were legitimate, then there's no argument.
So another leading question to that, Con, is that within the 6 year itself, if I moved out of my principal place of residence
We
and
might
I
want to
rented
write the
out,
question down, I guess.
can you hear me, Con? Is that better? Can you still hear me, Con? Can you hear me, Con? All right, let's put a question there.
Should the trustees in the trust be a company always a corporate trustee? The reason many people set up a trust is for asset protection. You negate all that as soon as you buy it in your own name, because the trust itself is not a legal entity. So they need a legal entity to represent it, and that's the trustee. If you're the trustee and that trust gets into trouble and you have to sell, as the trustee, the lender, for example, can go after assets in your own name. So we never recommend that you buy property in a trust with your personal name as the trustee. It negates the whole purpose of setting up a trust. It might be cheaper, but doing that, essentially you're cutting off your nose to spite your face. So no, for me, it's a no-no, always has been. And I guess on that, we always encourage clients to look at the end goal and not how can I do it cheaper. Cheaper is not always the best. There's an old maxim of you can have good or you can have cheap, but you can't get them both in one package. So there are advisors out there that are cheap. There are loans out there that are cheap, but is it suitable for you? And there's ways of setting up a structure that possibly may be cheap because you don't have the cost of a trustee company. But if a problem was to arise, you've also got no asset protection, essentially. Happy to have more questions if people want to throw them up. If I was to rent vest after moving out from my PPR in year 2, now rented, and I'm assuming it says and sell, no, you've got to move back in, because if you don't move back, then you've lost the principal place of residence or main residence capital gains tax exemption. So you do have to move back in. You can't sell in year 5 and still hope to get the benefits of the capital gains tax exemption. There will be a capital gains tax.
Yeah, that makes a lot of sense, Con. Can you still hear me now? Am I audible?
Keep throwing the questions up, folks, because I've
Am I
lost the
audible?
connection. Oh, here we go. Okay. That
Can you
answered
hear me
that
now?
question. Mate, I do apologise for this bad line. I think next time I'll join you in the studio.
That's true. Is that still
Yes.
better?
Oh,
Or
now we've gone again. So if someone wants to throw another question up, happy to go through it. Whilst we're waiting to get the connection going or to get another question up, I'll put this out there that we're quite happy to have any one of the clients of I Love Property. If they've got any questions, we will offer the first consult, no obligation, no commitment, purely confidential and totally free. Because I hate seeing where people take advice from someone on Facebook with no knowledge, or they made at the pub and they make a mistake. So we're quite happy to have this conversation either virtually or in our office in South Melbourne. If someone has any questions, we'll set up a Teams meeting or a Zoom meeting, and no charge to you. We're quite happy to answer your questions, run through scenarios and make sure that you've got clarity in your property investment journey. How many properties can you buy in an SMSF? As many as you can afford. Now, there's a distinction between residential properties and commercial properties in that in some instances in commercial properties, you can do some renovations. You can't really do renovations in residential properties if you've got borrowings on it. If you've got your own money, yes, you can. There's no limit to the number of properties you can own, apart from the fact that once you've hit the threshold for each beneficiary in an SMSF, which is about 3 mil, after that, you'll pay an additional tax on top of what you currently pay. So instead of 15%, you'll be paying 30%, for example. It's still better than 47%. But whilst it's a great, and probably after owning your own home, the SMSF is probably the next best investment structure. It's not necessarily the only investment structure. So the only limit is your capacity to fund properties in an SMSF, and also what your personal tax rate is versus what the next level tax rate will be in an SMSF. Because after a certain limit, the Australian government it used to be you can own $50 million worth of property and it was always going to be 15% tax and no capital gains tax if you sold once you retired. But they capped that a couple of years back now. And so there is a threshold, and above that you pay a little bit more tax. It's a matter of determining whether that additional tax, let's say 30% instead of 15, is still beneficial to you, as opposed to having that income in a trust structure where you may not have the option to distribute to too many people or in your own name. But there's no decree to say you can have X number of dollars or X number of properties. I'm back on board. I can hear you now.
Oh, perfect. Can you hear me now?
Can I borrow from my equity in an SMSF? So if you've got a investment property in a self-managed super fund and it's got equity, but you've got a bank loan against that property, you can't actually use the equity in that property to gear and buy another property. Because in a self-managed super fund, that the regulations only allow you to have one property, because the bank will take security of that property in a self-managed super fund, just that property, no other assets. So for better or for worse, until that loan is paid out, you can't use the equity in that property. So with clients that have got property in a self-managed super fund, they can actually make contributions outside of their normal super guarantee contributions for work, additional contributions up to 330,000 each. And that money can then be used to buy additional properties, or you can pay down the existing property that you've got, extinguish the loan with the lender, and then use the equity in that property to gear into an additional property. But you can't use the equity if there's already a loan on that property. How can you can claim depreciation? Now, the depreciation rules have tightened up in the last couple of years. It's generally new homes that you can claim depreciation on, or existing homes where you put in new fixtures and fittings. But depreciation has to be done by a depreciation schedule is generally done by a quantity surveyor, and you get your money back within the first year. But it's only quantity surveyors that will actually draw up a depreciation schedule for your property. It's always a good idea to have a conversation with your quantity surveyor, explain to him whether it's a new home or an existing home, explain the age of the home, because sometimes homes over 40, if they're older than 40 years, you can't get any depreciation on the actual asset. So it's not as advantageous as it used to be unless you're planning to do a lot of renovation on that property. So it's always good to have a conversation with a quantity surveyor to explain the property you're planning to buy, whether you're planning to do renovations, whether you're planning to put new fixtures and fittings in there. Maybe they need fridges, washing machines, etc. If it's a new property, by all means, definitely get a depreciation schedule done. Again, we work with a number of very qualified and professional quantity surveyors that are very well known in the industry, and they produce fantastic schedules that will be accepted by the Australian Tax Office. A new property is always recommended to maximise my tax returns. Okay, I'm not necessarily a fan of a brand new property. In fact, if I was to choose, I'd say I'm always a fan of established properties. Brand new properties, in some instances, are sold by marketing companies via real estate agents, or they get out there and they market apartments, for example, or brand new. Generally, it's apartments or a whole stack of new builds. Everyone has already built their costs into this, including the marketing company. They will take a percentage off the top. As I said, I've been doing this for 30 years now. The best capital growth has been in established properties for the most part, and it's dependent not on the property, more so on the land size, because as someone once said about 100 years ago, buy land, they ain't making no more of it. So that's where the value is. They say it'll maximise your tax return. Yes, they do. It'll maximise your tax return for the first 5 years, because you will be able to get depreciation on both the fixtures and fittings and the cost of construction. Fantastic. You'll get a great tax deduction for 5 years, and you'll get a percentage back on your taxable income. However, you more often than not do not get the capital growth that you would from an established property. And essentially, the reason you're investing in property is not for the tax benefits, is not from the rental income that you're going to get, positive or otherwise. It's to grow the asset, because that's what's going to grow your wealth. Growing the asset is going to grow your wealth. The tax deductions are a byproduct and possibly a benefit for a certain period of time. But I always say to all my clients, never buy property merely for the tax deductions. If someone's spruiking the tax deductions, and the only benefit they can tell you about this property is tax deductions, I would say steer away. Repairs versus improvements. Okay, so improvements become part of the cost base. If you have let's say you've got a particular room in the house, and it's made of, I'm not a builder, so I'll offend all the builders. Let's say it's made of timber, and you rebuild it and you've made it out of a stronger structure, you've used brick. That's an improvement, and it's part of the cost base. You can't claim it in the year you've incurred that cost, because it gets added to the cost base. In other words, it gets added to the cost of that property, and it will reduce your capital gains tax. And that is something you can depreciate, the improvement, because you've added it. So you can depreciate it even in an existing property. Whereas the repairs are something that have needed to be done. You haven't improved it, you've simply replaced it, and that can be depreciated in the year that it's actually incurred. I hope that's answered that question. Throw up another one if there's another question available. Capital gain benefit work with an example, including deductions. Okay, so let's work on a very simple example. Let's say, for example, and we won't worry about things like stamp duty and agents' costs and all the rest of it. And I'll use the example that it's in your own names, husband and wife, both on 47 cents in the dollar. So let's say you bought something today at 500,000. In 5 years' time, it's worth $1 million. You've essentially made 500,000 capital gain. Because you've held it for more than 12 months, you get what's called the capital gains tax discount. In other words, you pay tax on 50% of that capital gain. So on that $500,000 capital gain, you pay tax on $250,000. That, if the property's held 50-50 husband and wife as an example, then 125,000 of that goes onto the husband's income and 125,000 goes onto the wife's income. You essentially pay capital gains tax on 47% plus Medicare levy. So 125,000 is going to be about 61,250 capital gains tax each. So it's essentially around 122,500 on a capital gain of 500,000. I hope that was clear. As my old legal studies teacher would say, clear as mud, boy. Okay, next question if we can. If you move overseas for good, well, we've got clients that have done exactly that and they've kept the asset. They're holding on to it because it's got good capital growth. They're paying tax on the rental income that they've got. And at some point, if they were to sell it at some point in the future, then tax will be paid on the company depending on the laws of the country you move to. So because you've moved overseas permanently, you wouldn't be deemed an Australian resident. So the laws of the country you've moved to would apply in relation to that asset. You can decide to keep it and move back here and take advantage of it. But if you've moved overseas for good, you've got to determine what happens to that. So for example, sometimes if you move overseas, there's regulations around you have to sell within a specified period of time. But if that's not the case and you don't have to sell, what happens to that property is determined by the country you've moved to.
So, Kon, can you hear me okay now?
Yes, I can.
Yes. So let's just say I move overseas in that scenario, and of course I'm not paying tax here now, and I'm a foreign resident for tax purposes, right? So does that mean that I have to pay a highest tax bracket regardless of what that amount is, and then claim overseas, or how does that work?
So it's not that you'll pay the highest tax bracket. You will pay tax on the taxable income. So we've got clients, for example, that have got rental properties. They're assessed on that income on the rental property at essentially the higher rate. But what happens to that income when it goes overseas again depends on the income set up in that country and what the regulations say. In some countries, and I'm not aware of the tax regimes overseas in many countries, but in some countries, if we've got a dual tax treaty, for example, double tax treaty, you may be able to get credit for the tax that you've paid in Australia for the income that you've taken overseas. Because it's like if you own property overseas and you're living in Australia, if you've paid tax on that income, you will have to declare that income in Australia, but you offset the tax you've already paid against tax you're going to pay here. So whilst you may take tax here at the higher rate, depending on the country you've moved to, you may be able to get a credit for the tax you've already paid.
So that's a differential basically. So let's just say I pay at 45%, but I move in a country where maximum tax bracket is say 32%, then I'll get the difference 13% back.
Depending on what their agreements are with Australia.
Yeah, of course. I understand. Yes.
But potentially.
Is that the same treatment even in SMSF as well?
No. So essentially, if you move overseas and you've got an SMSF, you've got to, before you leave, you've got to appoint someone local to essentially act on your behalf. But once you move overseas, it becomes a non-compliant self-managed super fund, and therefore you pay tax at the higher rate. So unless you're planning to come back and you come back within a certain period of time, in which case you still have to appoint someone to represent you here locally prior to moving, so you can maintain the concessional benefits of a self-managed super fund. If you're planning to permanently move overseas, then you need to make plans to essentially divest the monies in the self-managed super fund.
Right. Okay.
We had one situation. They decided, I've got a lot of money in the self-managed super fund. I'll just get paid out of the self-managed super fund. Left, did nothing about it. It was handed to us by their lawyers. Well, unfortunately, it was a non-compliant fund and they were hit with quite a big penalty. So
you're
again,
saying
planning is critical. Speak to the lawyers, speak to the accountants before you make such moves.
Okay, we'll take one last question, Kon. You've been very helpful. And the question is, individual decides to invest in Dubai, for example, living here in Australia, and the asset creates a good cash flow. how would that get taxed? So basically, it's positively get overseas. How does that get taxed? Because especially Dubai doesn't
When
have
you're
any
living
tax.
in Australia, irrespective of where you earn income, whether you earn income in Australia or whether you earn income from assets anywhere else in the world, you need to declare all that income in Australia. Now, if, for example, any of that income has already incurred tax, let's say in Dubai, which I guess Dubai, there'd be no tax, you still have to declare it in Australia and you will get taxed at your top marginal rate. That income will be put on top of your personal income if it's in your name, and you will be taxed at the top marginal rate. I had
Right.
funnily, I had a question just yesterday. There was a client that set up a structure and said, and it was Dubai, funnily enough, I've actually got a property in Dubai. I don't intend to ever bring the money back. So that'll be fine. The problem with that is, the law says that it doesn't matter whether you bring it or not, bring it back or not. As an Australian resident, you will be taxed on income both here and overseas if it's been earned, not if it's been bought back in, but if it's been earned. So if it's been earned, it's taxable. So irrespective of whether you bring it back in or not, you need to declare it. And I can't stress highly enough, do not try to be evasive with the tax office. They have the capability, the technology to find if you've got property overseas, and they're getting better at it. The technology is there today. Don't try and be smart with the tax office. I always say to people, paying tax is a good thing. Why? Because you're making money. Even at 7 cents in the dollar, and no one wants to pay the higher rate. And if you've got time, have a look at Kerry Packer reporting to the Senate about 30 or so years ago and what he said about tax. But don't try to be too smart by half in relation to the tax office, because if you get an audit, not only will you pay the tax you didn't pay, but they can hit you for interest and they can hit you for penalties, which will be 2 times as much as the actual tax you tried to hide. And it's really not a wise thing to do. I've seen too many examples of people coming undone because they thought they were too smart by half, and they listened to some mate that said, pretend that you've got it all gambling income from the casino. Eventually they will catch up. And if you want to sleep soundly at nights, just do the right thing, pay your income tax, continue to build your wealth, and that way you can sleep soundly at night.
That's amazing, Kon. And I think we'll leave it at that. Just been phenomenal to have you on the show here. Your knowledge, experience, and the depth of coverage of different scenarios was just phenomenal. I'm sure we can talk for another 4 hours, and you'll probably have more to say. But it's just fantastic, and I think
Happy
all the
to
viewers out there. Sorry, and
look, more than
I just
happy. And
thought
first of all, thank you very much for the invitation. I appreciate it.
you're
And
welcome.
just to reiterate, for any of your clients that are interested in having a conversation around what they should and shouldn't do, whether it's an easy question or a complex question, as I say to everybody, there's no such thing as a dumb question. Always ask until you're comfortable. We're quite happy to take questions, have a meeting, no obligation, no cost, and purely confidential. But you can reach out to me via Facebook, via DM, or you can reach out directly through I Love Property. And we're more than happy to help, because I think the service that these guys are providing is, well, it's immeasurable, because they have got feet on the ground, they've got experience, but they've also got, they've got the insight into what's happening. And people may think that buyer's agents are expensive, but let me tell you, buying the wrong property in the wrong location at the wrong time can be 10 times more expensive. So as I
Thank you
said at
so
the start, build a team of experts around you if you're going to go on a journey of wealth creation.
Absolutely. And I think that A team is so important for anyone to be successful. You can learn as much as you want, read as many books as you want. You can't replace experience
If
and
anyone's
good
still awake,
experience.
thank you
Yeah,
for
I know.
listening.
Everyone's scenario is so different, and and no one person can actually answer everything. You really need the team. You need the
Wait to
right
see if
financial
we
broker.
get connected
You need.
again and we can say goodnight to everybody. Otherwise,
Yes, I think Gone. Your internet is probably bad. Can you still hear me? Okay, maybe not.
might have
Let
to
me just
see
hold
whether
on.
my service provider, Telstra, I don't know
Can you
if
can you
we're
hear me
still on.
now?
We're still on.
Is it better,
We're still
Con?
on. My
We're still on.
apologies.
No, you're
We're still
right.
on.
So yes,
Thank you once again for the opportunity.
thank you very much for we thoroughly enjoyed the session, and I would actually request viewers to reach out to Con if you have anything to do with SMSF, the SMSF advisors as well. If you've got anything to do with accounting, if you've got anything to do with finance, they've got one-stop shop to talk about all of those things. And Kon is quite accessible on social media and through us as well. We partner quite well. We work together. So please do not hesitate. I'm sure lots of people have lots of questions, but we are here to help and assist as professionals. And thank you very much for listening and have a great night. Thank you so much, Kon. We'll touch base again.
My pleasure. Thank you very much for your
Yes.
time.
Thank you.
Lovely. Bye-bye.